Welcome, everybody, to the Chinchilla Picking Podcast. It is December 21st, 2021. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I'm here with Brandon Beaver. Brandon, how are you, man?
Good. How about you?
I'm doing well. It's 4 days for Christmas. You could call this our Christmas show or a holiday show, whatever you want to call it. Happy holidays. I say happy Christmas. I say both, actually. So, do what you want. It's America, but enjoy it nonetheless.
Yeah.
Enjoy it. Enjoy this time with family. So,
Well, I just landed a job that I think is going to be a great opportunity. And it looks like so far I'm going to be starting on January 3rd. So we decided to take a last minute impromptu vacation to Universal Studios. I leave on December 26th, come back on December 31st. Not a lot of time to plan. And last minute flights are very expensive right now. Surprisingly, they're all booked up. And I was up until 4 o'clock in the morning trying to plan this vacation and get the ticket spot, get the hotel lined up. It was a pain, but I guess that's good for the economy right now, that these hotels that I was trying to book. First of all, we were trying to book the Aventura Hotel in Orlando, and we weren't able to do that. But that was because their website was not updated. So they thought they had a vacancy, but they did not. So they had to give us a refund, and then I had to find another hotel. But we're going to enjoy it. It's going to be fun. And I will report back with how packed the plane was or wasn't or whatever. And we'll see how the travel industry is doing and how Universal Studios is doing.
right. Go to that Hogwarts theme park there, Harry Potter.
Yeah.
Right. Yeah. I'm jealous. I want to see that place. I haven't been. I would love to see that place. Sounds like fun, man. Sounds like fun. And just for you guys listening at home, we are not going to be just a David solo show. We do have a guest speaker coming on. It is official. Nick Young will be making another appearance on the show. This will be his second appearance, I believe. So, Nick Young, we look forward to having you back next week. I know he listens as well as a bunch of other people. Brandon, I'll tell you this right before I know I want to hurry up and get in the show like you. I don't like a lot of fluff, but I will say this. I did get a little bit of feedback saying, hey, you guys were really going after each other last week in that podcast. And I was like, well, was it good or bad? Did you enjoy the discussion? Did you get something out of it? And everybody said it was good. It was good. Entertaining, and they also pulled something out of it. So we were entertaining and educational. We just need to be uplifted now, and we've got our motto. So there you go. We accomplished 2 out of 3 for that 1 week.
Right? We're growing really well. The last 2 weeks, the numbers have been off the charts.
Keep it up, guys. If you're listening right now and you're hearing Brandon say that, please, if you're enjoying the show and you like what we have to say, tell other people about it. Share it. Follow us on Instagram. Follow us on StockTwits. Brandon does the StockTwits. He's all about it. He enjoys that. So reach out.
Hit the subscribe button on Apple Podcast or Spotify. That way you have our episodes right away when you get into the car on Wednesday morning.
There you go, man. There you go. I like it. All right. What do you say we get into it, guys? Rules. Brandon and I get together before the show and we tell each other what we're going to talk about. We do not discuss it. You hear the live discussion here from the show, such as last week where we disagreed. So, this week's kind of more interesting. It's more of an informational from what I gather because Brandon's got a big chunk of meat that was to be continued from last week on SPACs. And what is SPACs? What's the word of SPACs? It's not Spanx, it's SPACs. So don't get it confused. All right. Brandon, take it away, man.
All right. So what are SPACs? It's a special purpose acquisition company, also known as a blank check company. This is a shell corporation that's listed on the stock exchange with the purpose of acquiring a private company and thus making it public without going through the traditional initial public offering process. The SPAC manager is given a specific period of time to find a suitable investment for the money raised, and if the investment is not found, the money is then returned to investors. So they go public. The idea is that you can't really have a target company yet, but once you go public and then you get the money, then you can start searching for a company to target. Now, if the manager finds an investment, it then goes to a shareholder vote. If it passes the vote, the money is then invested into the proposed company, but a large portion is lost to fees, which is why some investors believe the SPAC process to be too risky. The SPAC investors enter into the investment already with a loss of capital, and I'll explain why in a minute. Not to mention the fact that there's an incentive that the SPAC manager is going to find a company almost no matter what, because if they don't, they're going to return the money to the shareholders, even if the investment is maybe not such a good idea. He's going to try to sell it to shareholders as such. And here I want to be quoting directly. I'm going to be quoting directly from a Seeking Alpha article written by Dane Bowler, and he's the author of Income Portfolio Solutions. And I'll post the article here in the show notes as well. As a SPAC combines with the target company, additional shares are created for the SPAC manager. These shares are known as the promote. And while the size of the promote varies, it's often around 20% of the shares that the SPAC bought. For ease of math, let's say it is $100 million SPAC that buys $100 million worth of shares from the target company. And signing the deal, the target company gives it $20 million of shares to the SPAC manager. He lays out the math like this. If there was no promote, the SPAC investors would get X shares, right? But with the promo, the SPAC investors are getting Z shares, and the SPAC manager is getting Y shares. So this would be Z plus Y equals X, and Y is 20% of Z. So immediately the shareholders are only getting 80% of their value at most. And
that's only if there's a promo, correct?
There always is, almost in SPACs, almost every single time. So you're entering.
I just want to verify.
You're entering into the investment already with a loss. So adding up the percentage fee and the flat fee and the promote, about 25% of the investor's capital is going towards enriching the SPAC manager. So immediately you're 75 to 80% of your investment, and that's it. You've lost about 20 to 25% of the cash that you've put into this investment. So this is why I say stay away from SPACs. Once they've hit the market, then you might be able to find them for a value, but doing it prior to them finding a company and completing the merger is never a good idea. This is why I'm telling people to stay away from Digital World Acquisition Company, DWAC, because it hasn't happened with them yet. They haven't merged with Trump Media or whoever they're going to merge with yet. So I think you stay away from this because you're automatically going into this with a 20 to 25% loss.
All right, so a couple questions, man. I mean, when I go and I put my money in 401k, I know a percentage of that money that I make is going to be going to fees. Percentage of my account is going to fees, no matter what, right?
Yeah.
I assume that risk. That's fine. When I buy a stock and it drops, you know, and I hold it or I lower my cost basis, I'm assuming that risk there. Do you think that has any of these SPACs ever not returned back that 25% when they entered into buying the company?
I mean, I actually didn't do the research on the numbers of that, but
well, I mean, because my question is like, if they're all giving that money back and then some, then it is worthwhile. But if it's 50-50, or, you know, if there's a percentage of them that aren't, then yeah, now you gotta really dig in and see if this is for you.
Listen, we've been in a bull market, and I think that the fact of the matter is that investors are going to wake up to this 20 to 25% that you're paying for. And I don't think it's a good idea to do it. And we've had an incredibly hot market for SPACs in 2020 and 2021. And I don't think it's going to continue because I don't think the math makes sense. And I don't think a lot of retail investors understand that yet.
No, a lot of retail investors don't understand. I think a lot of people who have brokerage firms that handle their money for them don't understand it, and they don't know what they're investing in. I think a lot of people don't understand what SPACs are and what they're invested in. I know CNBC covered it every day for like about a year ago, and they were talking about SPACs every other day, and Fox Business and Cheddar and all the networks were Bloomberg. But, you know, nobody's talked about it much since they first appeared on the market. And now it's just kind of like, hey, you should know what a SPAC is. Well, no, not everyone knows what a SPAC is.
No, and I didn't know it until about 2 weeks ago. So,
And that's why I'm glad. Brandon, that you and I do this show together, because when you start researching something and you figure out something, you inform us all about what it is, and truly what are the fees, what are the consequences, what are maybe not the fees, how much return can we get,
mhm.
is there a pension fund in Japan running this thing? You know what I mean? I mean, that, I love that about you, but I wonder, because a lot of people keep pouring money into this. I wonder if most of them are giving back a good return, and that's why they keep appearing. Or is it they keep appearing because the people who start them get a good return and they want to keep producing them?
Just because it has happened in the past doesn't mean that it's going to continue happening in the future. And I mean, if you just look, the numbers just simply don't add up on it.
And the bear came out of hibernation right there.
So I think this is a product of a bull market that's in its late stages, and I would stay away from them.
Oh, I'll 100% agree with you. It is a product of a heavy bull market and a big bull run. And I don't know if it's in its late stages or early stages, though. And that's where I question. I can't say I disagree with you. I can't say I agree with you. I don't know enough of the details and the numbers to have an opinion. So I have questions that are not answered.
When in doubt, side with me.
Weren't you the one that did our very first podcast? Guys, go back to our very first podcast ever and just listen to it for like 15 minutes, and you'll have this saying in your head that bonds are dead.
I'm still, you know what? I had a target at 2% for the 10-year by the end of this year. That's not happening, and it's blowing my mind right now. And I mean, I think this is subject for a future show, but still sitting at 1.47, 1.48%, right around that area for that 10-year yield. And we're entering into a environment where the Fed's going to be raising interest rates. So it's going to be very interesting to see what's going to happen next year.
But they haven't yet, and we haven't hit the recession yet. Or we haven't hit a correction yet. So I mean, all those things that would cause the bonds, people to start moving money into bonds, hasn't happened yet. Yes, there's talk of all that stuff happening, but it hasn't happened yet.
So I want to.
So yes, go ahead.
Correct you real quick, because the interest rates are so low because people have moved into bonds, and that's what's driven the 10-year rate down, because the demand for it's so high they don't have to pay an interest rate that means anything. Because, and I don't know that it's actually the individual investor that's moving into the 10-year yield or moving into bonds. I just think it's the Federal Reserve still buying a ton of them, even though they've started the tapering process. So maybe that's what it is. Maybe it's a tapering. Maybe they'll let up on that, and then the interest rates will start to rise again. I'm surprised they haven't gone further than what they have, but it's bound to happen.
They need to stop the tapering altogether. If you ask me, it's propping up the economy falsely. You're seeing false numbers, and thus you're not trading correctly. You can't trade this market how we used to trade it, with all this pump going in day out. I never, when I first started trading the stocks, I never had this much pump going into the market from the government. I had to struggle actually knowing the fundamentals and researching and finding things, via Scottrade, and I think Thinkorswim was around back then. But I mean, like it's now it's like everything's so pumped up from governments that it's hard not to find a winner every now and then.
Yeah, and debt is cheap right now, which is great for the no growth, or not no growth, but no profit, high growth tech companies. But as those rates start to go up, then we're going to start to see, companies that don't have earnings, so those values are going to come down. So I mean, I'm not a bear on tech altogether, but I am a bear on tech that has been trading based on future earnings. First of all, because the cost of debt is going to go up. Second of all, inflation is eating those future earnings away. So if you're paying for those future earnings, the amount of money that you're giving to them for the future earnings is degenerating on a day-to-day basis. So If you're in tech, maybe I'm okay with Apple. I think it's a little bit high priced right now, but the Microsofts, the Facebooks, and stuff like that, that's where you want to be, not the Pelotons and not companies like that. Go ahead, Dave.
All right. So I agree with you and I disagree with you. So one thing I did not I take into consideration was the inflation numbers, how high it's been, and it does eat away at some of the earnings. Where I do disagree with you is historically we have bought tech with future growth earnings built into the stock price. That's historically how it's always been in the stock market. That's how it, and companies have always either produced or they no longer in existence. I mean, that's just how it works. So you have to be careful, just like when you're buying any company of who you're buying in. But I did forget about inflation. So some of those companies should come back down a little bit based off the inflation numbers. But I agree with you too. Like Peloton's overpriced, but they've taken a huge hit recently. I mean, do you get into a firm because they're technically a tech company, but yet they, are a layaway type, financial institution, but they only work with tech firms such as Amazon and so on and so forth. I mean, what do you consider tech? What don't you consider tech? I do like Apple personally, but at 180, I don't know if you guys heard the show about 6 months ago. I said 180 is a good price target to stop buying and put a hold on things. Mm-hmm. It recently hit that mark, and that's where I've said before I would put a hold on it. I wouldn't buy. I may even exit my positions. You gotta have those prices. So in 6 months, if you listened, it was at like 120 at that time. You're at 180, you would have made 50% in 6 months. It's not a bad return for a long-term hold and play. And for me, that's long-term. I know for a lot of people that's not long-term, but for me, that's long-term, So I don't know, man. I did not take into consideration inflation into the tech companies.
Yeah, who knows what's going to happen to Tesla, because that stock defies all physics almost all the time. I mean, I would stay away from it right now, but that's proven to be
Tesla's your unicorn. So if Brandon's saying stay away from it, I might buy now. Just because of that. That's your unicorn.
Now, in other news, another big symptom of a prolonged end stage of bull market, because that's where I think we're at, is mergers and acquisitions, lots of M&A activity. And a big one here, because Oracle, they don't pay a lot of money for other companies. They've only had a few, but they're paying $28.3 billion for Cerner. This is still pending shareholder approval, but I think that the shareholders are going to approve this, and I'll talk about why in just a minute. But let's get into what Cerner Corporation is. It's a supplier of healthcare information technology. The company offers a range of intelligent solutions and technology-enabled services that support clinical, financial, and operational needs of organizations. Cerner runs a gross profit margin of just over 82% and a net profit margin of 9%. So they're running pretty efficiently here. However, Oracle has about only $22 billion, and I say only $22 billion, like that's not a lot, but only $22 billion in free cash at the end of November. So you can kind of look at this, say, well, you've got $22 billion in free cash, but you're making an acquisition of $28.3 billion. Maybe you're paying with your future earnings, but the problem here is that the $22 billion in free cash flow is more than offset by about $73 billion in long-term debt. So this is giving them about negative $50 billion really to work with.
Oracle, well, hold on. You don't know the terms of the deal, how the deal is going to be done. So I would wait till I hear the numbers first before I say they're going to go into debt.
Well, no, they're paying cash for it, and they're paying $95 a share. They will have to raise additional capital, I think, to finance this purchase. And it won't surprise me if they sold more shares onto the market. They also have a rather aggressive share buyback scheme going on. I mean, scheme in a good way. I'm not against buybacks, but I think they're going to have to stop the buyback program, or at least slow it down. If I was an Oracle shareholder, I'm not, but if I was, I would not be happy with this. I'd probably sell my shares right now, even though it's been hit.
All right, so here's my questions. I just pulled up Cerner, and I'm pulling them up because I didn't get a lot of chance. We tell you guys, listeners, we do not discuss these things. We just tell each other what we're going to talk about. He brought this up right before the show. I did not get a chance to look it up. I'm looking up as he's talking because he did mention some of these things here right now. Cerner, FYI, Cerner Corp is a profitable company. Will they make back all the money they have to borrow in the first year? And does that pay off then? And now they have a profitable company they just bought with all that cash on hand.
Larry Ellison said that it'll be a credit to earnings for Oracle within the first year.
So boom, it's going to pay off the debt that they have to accrue to buy it within the first year. So it looks like it's a good play if you're playing long term like Larry Ellison does, because guys, he's a very smart guy. He's probably like what, second or third richest person in the world, up there with all the other guys. But like I don't know, man. I don't see it as a bad deal. I think they're overpaying, like you say, but in the end run, if it turns out good for them, then good for them.
So this is going to be $95 share. $95 a share would bring Cerner to a price to earnings ratio of around 56. So it's pretty high. I mean, for an acquisition, and that's trailing 12 months, I think you're looking at about a PE of 30 if you're looking at a forward PE. For an acquisition, it's not incredibly high. But if I was looking at the stock individually for myself and I saw a PE of 56, I would stay away from it personally.
Oh yeah, you and I would too. But like
an acquisition, if they think they can use that as an anchor to get into the healthcare field and fight Microsoft, which just purchased Nuance. Well, they're still in the process of it, but and this is one of the reasons why too. You look at the Microsoft purchase of Nuance; it was just okayed by the UK. The EU regulators. And this is why I think I'm right now, like you're trading at about a 5% discount to the $95 a share price target, but you can maybe look at this as a bond. I don't think that Cerner's shareholders are going to decline this. This has been about a 20% increase since the rumor hit the market. So if the Cerner shareholders declined it, you'd probably lose 20% again. So I don't think they're going to. And Microsoft just getting their approval from the EU for buying Nuance, it's a very, very similar acquisition here. I think they've paved the road for this acquisition to be approved as well. If the EU is going to approve it, then certainly the U.S. regulators will as well.
Not always, but yeah, you're correct. 99% of the time, yes. Now, here's the thing: like you mentioned, Microsoft and Nuance, and GE's in the medical field. They have medical devices. There's big players in the medical field for a lot of other technology groups. Intuitive Surgical is a great company to buy and own if you long term, if you have the money for it. But I mean, here's my thought is that these companies are trying to expand. Microsoft a lot of cloud. That's where they get most of their profit from every year. Cloud services, web services, boom, is a money maker for Microsoft, and it's made the money consistently over the last 5 years, and they've grown because of that, because that's produced the cash to go out and do all these other stuff. Now, Microsoft also has these government contracts with, I mentioned on the show a few weeks back about VR with the HoloLens and the United States military, and using the HoloLens to use drones and robots to fight for us instead of people and all that kind of stuff, and help them see the battlefield better. And Microsoft is getting into every aspect of your life. You're going to see these umbrella corporations. If you're a gamer, you know what I mean. Umbrella like corporations now popping up in the United States of Google, Microsoft, Oracle, and so forth, that are in every aspect. And you're going to have soon, like you see in China right now, you have a Baidu city. Mm-hmm. When are we going to have our Microsoft city or our Google city or Apple city? And what citizen are you of? You know what I mean? I mean, where do we take this? Or am I just going too off the deep end philosophically here?
But I know it. I mean, we were like, what, 5, probably 10 years away from the metaverse from taking over our lives.
Right. So how do we make money off this? Are you saying that you're saying you bought Cerner, right? I bought
Cerner, and I know it's only 5%, but I think that this is almost a guarantee. Again, I don't think that I did the same thing with Nuance earlier this year, and I didn't have to wait. The deal's still processing for Microsoft and Nuance, but I'm already out of it, and I still got my 5% profit.
And what price point did you get in on Cerner?
$90 even.
$90. Okay, nice. All right. So and that's about where it's sitting right now. So I mean,
I was surprised by it. I put in a limit order for $90.25, which is exactly 5%. and I
Yeah.
got $90. So I was like, hey, good job, TD Ameritrade. Thanks for that. Even though it was trading, it was trading at like $90.30. I don't know if there was a low liquidity there or what, but I got a better deal than what the market was offering. So, and analysts at CFRA, they cover Cerner. They give it a hold rating right now just because of this deal that's happening. It had a buy rating, but it was trading in the $70 range when it had a buy rating. So, and this is analysts at CFRA. They say that Cerner will operate as an independent business unit within Oracle and serve as an anchor asset for Oracle's move into the healthcare space. Cerner shares jumped nearly 13% on Friday. I think that was December 17th, after initial reports of the acquisition, at which point we lower our opinion to hold from buy with far less upside potential for Cerner in our view. The deal is expected to close during the calendar year 2022, pending regulatory approval and Cerner's shareholders tendering of the majority of the outstanding shares in the tender offer. I think it's going to happen. The reason why I'm buying it right now, I like to have some stability in my portfolio, given the fact that you can't really buy bonds right now. And I think I'll make the 5% in probably 3 to 4 months. And that's a long time period.
I think you're going to make the 5% sooner than that, man. You're going to make that money way sooner than that.
You know what? They might be, they might give the risk premium there. It may stay around 5% until the Cerner shareholders approve it. I think I had to wait a couple of months on Nuance, but we're almost at fair value right now at $90 a share. It may be a little bit more over. It may be overvalued right now, but with the floor being about 15 to 20% lower than where we're at right now, I don't count on Cerner shareholders rejecting this offer.
Gotcha. I don't know, man. Morgan Stanley said it was a $95 price target.
Yeah, and that was
so did Barclays.
That was before this offer. That was before they put a 95. So did the street, even though the street is bullish on just about everything. They put a $95 target on it too before Oracle made the offer. So,
right, the street's just bullish about everything. That's good, man. That's good. I like that.
They put a lot of effort and a lot of good thoughts into the report. So I read the reports from the street, but I their price targets, I give a grain of salt to the price targets, because I mean, it's very rare that you ever see a hold, and it's much rarer when you sell rating from them. So,
all right, man. What else you got for us?
Here's something to think about. If you're an Oracle shareholder, and this is another reason why I'm bearish on the Oracle side, but bullish on the Cerner side, rising vaccination rates, and you can make this argument that rising vaccination rates and new COVID variants, this is going to fuel the digital transformation in healthcare. But this is a double-edged sword, because the rising COVID rates with Omicron and what's happened to the hospitals over the past couple of years, this may mean, and probably does mean, that hospitals are going to have to budget crunch even more than what they're doing right now, because there's been such a high cost of business for the hospitals right now. They've been so overcrowded. This may be a headwind to healthcare spending, which is what Cerner is going to rely on. They're going to rely on these hospitals to come out and buy their systems and buy their transformation into the cloud and stuff like that. The hospitals don't have the money to do it. They're not going to be able to.
All right, so here's where we disagree a little, buddy. I believe that a lot of these hospitals are already in the cloud and they're working together and they already digitized everything. Now, the stat you threw out before the show was about for every 1 hour someone does with a patient, they got to do 2 hours of paperwork.
Yeah.
Right. I believe most of that, if not all of that paperwork is now digital in most doctors' offices. And so
2 hours.
Yeah.
With a patient.
You still have to type up and do all that paperwork. The reason why you got to type all that up and do all that paperwork is because of malpractice. It's because of the lawsuits. It's because of lawyers. It's not because there's not the system there. Someone's got to first put the information in. I mean, I guess you could do a mic like we're using and talking to the computer. I had one doctor who was doing that, talking to his computer, and it was typing in all the information there. But I mean, like it's pretty much digital right now. I mean, there's ways to improve it and make it better. Yes. There's better computer programs out there. Yes. But I'll be looking more in terms of if I want medical technology, I want I would look more of like Intuitive Surgical that creates machines that can actually perform the surgeries without the need of a doctor.
Maybe
Right now, they need a doctor. Huh?
Maybe Salesforce will buy Intuitive Surgical.
There you go. Right. But I mean, that's kind of where my head's at. I mean, I see there's still a desperate need for this, and I believe that most of these major hospitals are already in the cloud, digital, working together and moving files quickly between one another. That there's no need for me to carry my X-ray from one place to another. They could just send it and they get it right away. Yeah. It's all done digital. It all did that after 2000 and
there's a lot of work
when the Affordable Care Act passed.
There's a lot of paperwork they have to do and digital, paperwork, things like that they have to do to get around laws and regulations as well.
HIPAA laws, malpractice suits, all kinds of laws. Check this, sign this, approve this. It's all because someone sued at one point in time, and now everybody has to do this. And this is unfortunately how it works. But there's maybe there was a good reason for that suit at that time too. You don't know.
That's all I got.
Cool.
Terrible transition there.
Right? It's just boom. Boom. On to you, David. All right. Here's what I got, guys. I want to talk a couple things. I made 2 calls last week, so I want to cover this real quick. I was on here at the end of the show. I made a call on Cooler at $288. That's for the price it was at the time I made the call. I said $288 on the podcast. I said that's a buy. Back up the trucks is what I said. Load it up. Right now, I'm pulling it up as we speak. Cooler's at $307. I even posted on Instagram. I believe it was Thursday of last week. I posted on Instagram saying, go ahead and sell. Cooler was at $321 at that point. I was like, you made a good amount of money, 10% or more. Take your profits, run. If you did Cooler, if you did Riot, you were up at that time because I said buy Riot, and I said my price point on Riot is 25. If you bought Riot and you did not sell when I posted on Instagram and it was over 26, I said, buy, sell both, take your profits, get out of them. If you're still holding Riot, don't worry about it. All right. You don't need to hurry up and sell. If you can lower your cost basis, lower your cost basis. Currently, Riot is sitting out. Let me pull it up. Riot is sitting at 24.20. So you're not that far below 25. Riot will go above 25. You will make a profit on this. You just have to hold it. If you didn't sell Thursday of last week when I posted on the Instagram, don't worry about it. You will make money on Riot. You just got to hold it a little bit longer than what we want to. We never like to trade and hold for that long, but don't worry. Riot's going to go back up. Bitcoin's not going anywhere. It's going to go back up no matter what Brandon says. And it's a good stock to buy, I believe, right now. So that was my the review of my calls from last week. Looking ahead right now, we got NVIDIA at below 291, below 300. Is that a buy? Is not that a buy? I don't know. I got to see the news coming out because I'm worried about a recession. I'm not going to be calling any more buys for the last week of the year just because I'm worried about what's going to happen with people moving funds around, people about the Fed interest rates, what's going on. I just don't know enough to make calls on the show like that. That's going to be my concern. Maybe I'll talk about that with Nick next week. But as far as oil took a rise up. So all the oil stocks went up with it. It was good for the oil companies. They went up like rising tides raised all ships. Rig, Schlumberger, XOM, APA. I'm looking at my list here. They all went back up. Will Tesla go back above 1,000 again? Yes. If you have enough cash to buy 1,000 shares of Tesla, go ahead and buy it because you're going to make money. Brandon says no, but Tesla is Brandon's unicorn. If you don't know what a unicorn is a mythical beast that you can never catch. Brandon has called Tesla wrong numerous times.
It shouldn't have dropped because Joe Manchin came out and said he was going to block the spending bill, the infrastructure spending bill, and I think Tesla unfairly got hit because of that. But very high multiple growth tech companies right now. I'm not comfortable with it going into interest rate hikes, and interest rates do matter to stocks.
All right, yeah, but here's the thing: like, is there any competition, really, real competition in the Tesla? I mean, you got Rivian out there, you got Chevrolet pushing out electronic vehicles. Right now, for the next 2 years, is there a competition that you foresee for Tesla?
Ford F-150 Lightning, and I think that's it.
Okay, all right, I'll give you that.
Rivian, I think, is a different demographic than what would buy like a Cybertruck or a Model S.
I agree. Rivian is a different demographic, and it's I believe Rivian. If you buy a Rivian, you're the same type of person that would buy BMW. So, I'm going to say this joke here, and it's just a joke, by the way. You know, this is a podcast where this is just a joke. If you ever think that what you're doing doesn't matter, just think there's a guy at a BMW plant making turn signals.
That's true.
All right, final thoughts, Brandon. Lead us out, man. What you got?
In regards to Cerner, you put a little bit of money into it right now. Don't put a ton of it, just in case the Cerner shareholders do decide to decline it, or in case there's some sort of regulatory issues that I am missing. But I don't see any antitrust issues here. It's not making Oracle. It's not making Oracle into any kind of monopoly. So you can dip into it a little bit and then buy a little bit more after the Cerner shareholders approve it. I do think that you're going to have some regulatory hurdles. You're going to have some shareholder lawsuits and all that stuff. This is all par for the course on acquisitions. And anytime it dips, below the 5% target, if you can get like 5%, 5.5%, then you can buy into it and you can just sit on it, I think. And then you make your 4.5 to 5%, and you get out.
I agree. I like it, man. I like it. Final thought for me, guys. If you bought Cooler last week, when I called it at 288, 290, somewhere around there, you're up right now. Sell, get out, take your profit, be happy with that. Riot, if you bought it at 25, when I said to buy it at 25, and you did not sell last week, and I posted to sell on Instagram, don't worry, it's going to go up. If you didn't lower your cost basis, maybe lower your cost basis a little bit. It's going to go up. You will make money. We'll be profitable on that. Don't worry about it. Have faith in the chinchillas. Like always, guys, if you want us to come talk at your university, social club, school, what have you, whatever it is, work, reach out to us, DM us. We'll see if we're available, see if we can do it. Yeah, we don't mind at all. We don't mind doing like a live podcast if that's what you want to do. We prefer Tuesday nights. That's the middle of the week. People are really into the market. It's a good time of night. But if you want us on the weekend, we might do some kind of recorded show for people out there. Let us know. Reach out to us. DM us at Chinchilla Pickin'. We're on Instagram. We're on StockTwits. We're on everywhere. We don't have any TikToks up right now, but we are on TikTok. So if you want to follow us, and hopefully I'll put something up. I don't know. But give us a shout out. Let us know. Reach out to us. We're always here for you. As always, we've been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Have a good night. If you've listened to our podcast before, you know that we are good friends with the Money Vikings, and we think that they have a lot of good knowledge and, just a wealth of knowledge to offer. About 60 years worth of knowledge and trading experience between the three, between Greg, Bob, and Jerry. Now, I have some good news for you because they have announced a premium program. It's the Money Vikings MVP premium content, okay? And I have to tell you this right now. If you're new to the market, you have got to have somebody to mentor you through it, because 75% of all new market entrants will lose all of their money in the first year, and you have to have somebody that will guide you through it to prevent you from making these mistakes that most people do. And with this MVP access, this premium content, you will get direct access to Greg, Bob, and Jerry on Discord. That's the most important feature of this program, in my opinion. They do also have they will give you access to other things such as hot trades, weekly newsletters, technical analysis. Hey, it's ad free. That's cool too, right? Guides and tutorials, tools and custom technical indicators, exclusive analytics and informative articles, and then, as I said, exclusive direct access to Greg, Jerry, and Bob, who have over 60 years of experience between them. Now, if you listen to this podcast, you need to get a pencil and you need to get a paper and you need to write this down because you get 25% off. Once you go to moneyvikings.com and you sign up, you'll get to enter in this code. It's capital TMV P1CK1NS. That is all capital TMV P1CK1NS. An easy way to remember that is TMV Pickens, but the one replaces the I. So go to moneyvikings.com, claim your discount for being a Chinchilla Picking Podcast listener, and conquer your financial freedom.